Support for today's episode comes from Amazon. Amazon is working toward a carbon-free energy future, doing more with less, investing where it matters most, and supporting communities where we operate. The next lithium shortage may be financial, not geological. For much of the past 2 years, the lithium market was defined by oversupply. Prices fell, battery costs came down with them, and producers reconsidered expansions planned when prices were near record highs. That correction helped battery buyers. It also weakened the investment pipeline that future supply will depend on. For much of the past 2 years, the lithium market was defined by oversupply. Rapid production growth pushed prices lower, reduced battery costs, and forced producers to reconsider expansions that had been planned when lithium prices were near record highs. That market correction helped battery manufacturers, but it also weakened the investment pipeline that future supply will depend on. The International Energy Agency's Global Critical Minerals Outlook 2026 shows how sharply capital retreated during the downturn. Global investment in critical minerals fell 9% in 2025, ending several years of growth, and the pullback hit lithium hardest of all. Spending by lithium, nickel, and cobalt companies combined declined more than 20%, the largest drop in over a decade, but lithium-focused companies on their own cut investment by around 40%. Exploration spending told a similar story, down more than 10% across the board, closer to 45% for lithium and nickel specifically. The concern is not that the world is running out of lithium in the ground. It is that weaker prices caused companies to postpone, resize, or abandon projects that would be needed if battery demand keeps rising through the 2030s. Lower prices weakened the project pipeline. Lithium prices fell steeply during 2023 and 2024 after new production and downstream inventories grew faster than demand, reversing a period of exceptionally high prices that had encouraged investment across Australia, China, and South America. The resulting supply growth benefited battery buyers. Average lithium-ion battery pack prices fell by approximately 8% in 2025, while battery storage system prices declined to roughly one-third of their 2020 level. For lithium producers, though, the downturn weakened project economics and made financing harder, pushing many to cut capital budgets, slow expansions, and concentrate spending on their strongest margin assets. Albemarle provided one example in February 2026, idling its Kemerton lithium hydroxide plant in Western Australia while supplying customers through other channels and keeping its Australian mining interests intact. Not every company retreated. Rio Tinto completed its $6.7 billion acquisition of Arcadium Lithium in March 2025, a counter-cyclical bet that long-term demand would outweigh near-term weakness. Companies with large balance sheets can often acquire or advance assets during a downturn. Smaller developers dependent on external financing have far fewer options once prices fall. Prices recovered faster than investment. Lithium prices more than doubled during 2025 and early 2026 as energy storage demand strengthened and supply conditions tightened. But that recovery does not automatically restore the projects deferred during the downturn. A higher commodity price can improve project economics quickly. Mine development cannot respond at the same speed. The IEA's analysis of major mines across all minerals, not a lithium-specific figure, found that projects entering production between 2010 and 2019 took more than 16 years on average from discovery to first production, with exploration and feasibility alone accounting for more than 12 of those years. An operating producer can often restart curtailed capacity relatively quickly. A newly discovered resource cannot become battery-grade supply just because prices rise, so the fallout from the downturn depends heavily on which kind of project got delayed. Demand keeps broadening beyond vehicles. Electric vehicles remain the largest source of lithium-ion battery demand, but stationary storage is becoming more important. Battery demand overall isn't slowing down. It grew by more than 35% in 2025 to exceed 1.5 terawatt-hours. And lithium demand itself rose by an average of roughly 25% a year across 2024 and 2025. EVs still account for the bulk of that, more than 70% of lithium-ion battery deployment. But storage has climbed past 15% and keeps gaining ground. That broader base changes the market's exposure, since a slowdown in EV growth in one region no longer determines the whole outlook. The IEA projects lithium demand will more than triple by 2040 under its stated policies scenario, the strongest growth among the major minerals it tracks. Though battery chemistry shifts, recycling, and sodium-ion deployment could all still alter that path. The projected gap has narrowed, not disappeared. The supply outlook has improved since earlier IEA assessments, with more announced projects now expected to reach production and narrow the projected 2035 gap between mine supply and requirements. The IEA's base case still projects lithium mine supply below primary supply requirements in 2035, although the gap has narrowed compared with earlier outlooks. And those projections depend on announced projects actually being financed, permitted, built, and ramped up on schedule, since an announced project is not the same thing as an operating asset. Public finance commitments for critical mineral projects in advanced economies reached approximately $65 billion in 2025, more than 4 times the 2023 level. But the IEA cautioned that a substantial gap remains between commitments and actual disbursements. Public funding can lower risk through loans and guarantees, but it cannot substitute for private capital and long-term buyers willing to sign on. The chain also faces its own internal imbalance. The IEA found that diversification investment outside dominant suppliers remains concentrated in mining, while refining and downstream manufacturing lag, and planned cathode production capacity is only about 1/3 of projected lithium mining capacity. A country can develop mineral resources without building enough regional capacity to convert them into battery-grade materials, so supply security depends on conversion capacity as much as reserves in the ground. Domestic resources still need a commercial path. New lithium projects continue to advance in the United States, part of a broader push that has also included a separate commercial deal putting East Texas brine resources on the domestic market map. In March 2026, a Standard Lithium Equinor joint venture signed a binding agreement to supply Trafigura with 80,000 metric tons of battery-grade lithium carbonate over 10 years from its Southwest Arkansas project. Separately, the U.S. Geological Survey estimated that 5.1 million to 19 million metric tons of lithium may be present in the region's Smackover Formation brines, though USGS did not determine how much would be economically recoverable. Neither an estimated resource nor an offtake agreement guarantees production. Developers still have to prove out extraction performance, secure environmental approvals, build processing infrastructure, and consistently deliver battery-grade material. Direct lithium extraction could improve prospects for some brine resources, and the technology has gained real commercial momentum, though its performance varies with brine chemistry and project design. The IEA has cautioned that scaling projects built exclusively around it remains difficult. The same test applies internationally. Government incentives can improve financing conditions, but they don't eliminate the geological, permitting, and market risk underneath a project, the same gap between resource potential and financed capacity that has been playing out across critical minerals more broadly this year. Future supply depends on decisions made during the downturn. Commodity markets frequently create the conditions for future tightness during periods of low prices. Supply exceeds demand. Prices fall. Producers cut spending. Exploration declines. Projects get deferred. By the time demand catches back up, the pipeline may no longer respond quickly. Lithium is not certain to see a severe shortage. Prices could encourage restarts. Recycling could reduce the need for new mining. Manufacturers could shift toward chemistries that use lithium more efficiently. What the evidence does show is that the financial foundation for future supply weakened considerably in 2025, and the pipeline remains dependent on capital returning early enough to outrun mine development schedules that run a decade or longer. For procurement, manufacturing, and infrastructure executives, project execution is a more useful indicator than spot prices alone. A rising lithium price shows the market has tightened. It does not show whether enough mines, conversion plants, and downstream facilities are being financed for the next decade. The next lithium constraint, should it emerge, is unlikely to reflect an absence of lithium resources. It will reflect whether enough commercially viable mining, conversion, and downstream projects secured capital and entered production before demand caught up. Sustainability Soundbites energy coverage is sponsored by Amazon. Visit the link in our show notes to learn more about Amazon's spotlight on energy. For sponsorship opportunities with Environment and Energy Leader, please reach out to a member of our team.